During yesterday's job market report, it was highlighted that for the first time since the pandemic, we now have less job openings than total unemployed people. And because of this, the Federal Reserve is actually considering an unprecedented jumbo rate cut to save our economy. So in today's video, we'll be breaking down this job market report. Then, we'll be talking about the major risks facing our economy. And finally, I'll be talking about what I'm doing to my investment portfolio, more specifically, my stock market portfolio. So first, let's talk about the unemployment rate, which came in at 4.3%. And so although by just looking at this chart, you may think that 4.3% is actually super high, in the grand scheme of things, it's not that high. Now the problem is, first of all, the unemployment rate is a lagging indicator, which means it's usually the last thing to budge when it comes to analyzing the job market. Now, and the second big problem is that typically when the unemployment rate starts to rise, it never stops there. We can see that ever since the 1970s, every time the unemployment rate spikes, it usually doesn't stop, and it continues to go up until we finally get into a recession. And because the unemployment rate is a lagging indicator for the job market, let's now analyze some of the best leading indicators for the job market. And the first one being the US employees non-farm payrolls, which is basically a report that tells us how many new jobs were added in any given month. And it excludes jobs like farming and government, so it really focuses on the private sector of the economy. And we can see that in August, we added only 22,000 jobs. This came in far below estimates of 75,000. And to make things even worse, the non-farm payroll numbers for June were revised much lower. So initially, they had reported that June was a positive month. We added 27,000 jobs. That's what was initially reported. But just yesterday, they revised that to negative 13 jobs. So that means for the first time since 2020, we actually had a negative jobs print, which is a major red flag for the US economy. The next leading indicator I want to talk about is job openings. So this, as the name suggests, tells us how many job openings there are for the total US economy. And we can see that ever since 2022, this number has been plummeting. And we're now sitting at around 7 million jobs open for the United States. And this is what I referred to at the beginning when I told you guys that there are now more unemployed people than there are job openings. So this means we have more than 7 million unemployed people in the United States. And to put that into context, during the very lows in the pandemic, we had around 4.5 million jobs. And so we're now getting much closer to that level 5 years later, which is, again, another major red flag as a leading indicator for the job market. The third leading indicator I want to talk about is probably one of the more interesting ones, and it basically talks about job quits. So how many people are quitting their jobs? And we can see that once again, since 2022, people have not been quitting their jobs. And this is for a very simple reason that people think that if they quit their job now, they're going to struggle to find another job, which is, again, another major red flag for the US economy. Now, the fourth leading indicator I want to talk about is actually not as bad as the previous three. So it's initial jobless claims. So how many people are claiming that they're jobless is essentially what this report tells us. And we can see that over the last, call it 3 years, this number has been relatively stable. So it's not really skyrocketing as the other previous leading indicator. So out of the four leading indicators, only one is flashing a green flag and 3 of them are flashing red flag. And we can actually combine all of these leading indicators into one index called the Leading Employment Index, which basically aggregates the jobless claims, average hours worked, new manufacturing orders, building permits, stock market performance, and consumer confidence into one index. And we can see here, if the leading employment index is rising, it usually means the economy is expected to grow in the next 6 to 9 months. And if the LEI is falling, it usually signals that the economy is slowing and could tip into a recession. And economists often look at the 6-month trend, and a sustained decline is a major red flag. And if you look at the LEI, we can see that ever since 2022, so not only in the last 6 months, basically over the last 3 years, the leading employment index has been falling off a cliff, which is a major red flag for the US economy. And the one thing saving this leading employment index is the stock market performance, because ever since 2022, we've really only had one pullback in April. And this was a V-shaped recovery, and now we're back sitting at all-time highs. So you might be wondering to yourself, how is this possible? How is it that the economy is signaling major red flags, yet stocks are at all-time highs? Well, simply put, that's because the stock market is not the economy, and the economy is not the stock market. And the one thing that heavily affects stocks is not really unemployment, but it is corporate profits. So if companies are shelling out record profits year over year, then there's no reason for stocks to sell off. And as we can see in this chart, corporate profits are at all-time highs, so it does make sense why stocks are also at all-time highs. Now, the one risk to this is major unemployment, because if people start losing their jobs, corporate profits will fall. I mean, just think of it. When people start losing their jobs, they don't have enough money to buy food at Walmart, they don't have enough money to go shopping on Amazon, they don't have enough money to be buying stuff online, whether it's on Instagram, whether it's on Facebook, whether it's on YouTube. So major unemployment does heavily affect corporate profits. And that's why the Federal Reserve now has to step in to save the job market. Because nobody else can do it. Not Trump, not Congress, not the House. The only one who really has the power to save the job market is the Federal Reserve President Jerome Powell. And the one tool he has to make this happen is by cutting interest rates, which is exactly what he's expected to do in September 17th. And the market now expects a 100% chance of cuts during the next Federal Reserve meeting at September 17th. And we're also expecting 8.3% chance of a jumbo rate cut. So that's a 50 basis point rate cut during the next meeting. And so now let's quickly explain why rate cuts would be good for the US job market. Right now, interest rates are sitting at around 5%. So this makes it very expensive for individuals to take out loans to buy things like houses, for example, and it makes it super expensive for corporations to take out loans to invest in the US economy. So when interest rates drop, it makes it easier for individuals, consumers, businesses to take out loans and start investing more money, which essentially stimulates the US economy. The risk, however, is rising inflation. Because with inflation already sitting at 2.7%, which is already higher than the baseline inflation target of 2%, rate cuts will only add fuel to the fire and cause inflation to rise even more. And so although people typically think that rate cuts are bullish for stocks, let's just take a look at history. Because over the last 3 rate cutting campaigns, we had major bear markets in stocks. So the first one was in 2020, second one was in 2008 during the financial crisis, and the third one was during the dot-com bubble in 2000. Now, the one thing all 3 of these events shared in common was a black swan event, which is basically an event that triggers this major sell-off. So in 2020 was the pandemic, 2008 was the housing crisis, and in 2000 was the dot-com bubble bursting. So essentially, my conclusion to this is rate cuts are only bullish for stocks if we don't have a black swan event. But if we do have a black swan event, something like a major war breaking out, something like a pandemic, something like a bubble bursting, then we can expect major pullbacks for stocks. But the best case scenario I see for the economy is the job market kind of stabilizing once we implement these rate cuts, but inflation continues to rise. And the worst case I see for the economy is it's too late to cut rates, job market continues to deteriorate, and inflation continues to rise, which would essentially be called stagflation, which is probably the worst thing you can have for any given economy. But the one consistent thing in both of these scenarios is rising inflation. And that's why I think the best way to protect yourself from consistent inflation and consistent money printing is to invest in assets. Because when inflation rises and when money printing is rampant, the US dollar is worth less and less. And that means everything measured in US dollars will be worth more. So think gold, think stocks, think real estate, think crypto. Everything measured in US dollars will be worth more. So investing in scarce, desirable assets is the best way to hedge against inflation. And as far as what I'm doing to my personal portfolio, well, first, let's take a look at my performance over the last year. It's been 1 year exactly since I started publishing my trade alerts in my private Discord group. And since September 6th of 2024, we're up 72% on my portfolio versus the S&P's performance of 19%. And just for reference, I don't do any day trading, I don't do any options. This is strictly long-term investing. And so although I'm significantly invested in stocks, and I think it's one of the best ways to protect yourself from inflation, I still do have a significant cash position of 9%. And I have a few defensive plays like Lockheed Martin, for example, that perform really well during bear markets. So in that case, if we do get a bear market, I have a cash position and I have a few defensive positions that I can use to buy the dip on stocks that have sold off 40, 50, 60%. So to quickly summarize what we talked about in this video, although the unemployment rate is sitting at a healthy 4.3%, the leading indicators for the job market are flashing red flags. And so to combat that, the Federal Reserve is finally starting to cut rates. Now the risk, however, with cutting rates is that inflation will continue to rise. And the best way to protect yourself from that inflation is by investing in scarce, desirable assets like real estate, gold, stocks, or crypto. And so I hope you guys enjoyed this video. Make sure to drop a like if you found value and make sure to subscribe for more. Peace.